In this video, I'll show you exactly how to get set up on a trading system and then exactly how to trade assets. Which assets do we want to trade and why? When do we get in? When do we get out? What is the analysis behind that? And then physically, how do we actually enter those positions? All of that in this video, and I'll leave timestamps for everything down in the description below. The first thing we need to do is figure out which asset that we want to trade. If you're just beginning, just choose one asset only that you want to trade and you want to become an expert in. There are just so many assets out there, all with different influences on their price. If you spray and pray and take a load of different positions, you're going to be diluting yourself. Become an expert in one asset only and how it moves. Now for me, Bitcoin is that asset. Bitcoin is an index and it actually moves up and down alongside other indexes. It's slightly more volatile than them though, and that means it's better for trading positions. So for me, I'll show you trading Bitcoin in this video. I'll also show you how to get set up on Bybit, which is the trading system here. So I'll leave a link below to Bybit. If you don't have an account, you can click that link, and when you sign up, they'll give you a trading bonus all the way up to $30,000. Depends how much you deposit. Anything you deposit, they will give you a bonus. I'll leave some other links to some other exchanges I use and a lot of helpful videos and a lot of the resources in this video. I will leave all of that linked down in the description below. There's two ways to invest in trading crypto. So the first one is trading in the spot market. On any crypto trading system, if you go to trade here, you'll see spot and futures. Okay, so this is what most people trade. Spot is where you cash settle your trades. So if you have $1,000 in cash or a stable coin, you can spend that $1,000 and buy Bitcoin. You now own $1,000 of Bitcoin. That's it. You cash settle the trade. That is for investing. And if you're just beginning with trading as well, I would highly recommend just sticking to the spot market. Now with futures, this is what people trade when they're slightly more advanced, maybe intermediate or advanced traders. This is where you can take leverage with your trades. And this is similar to in the stock market if you can get margin from your broker, right? Which is where you put $1,000 of cash in your brokerage account or your crypto trading account. And they say, okay, you've got that $1,000 there. We can now let you trade in the market and place a trade with bigger size than that. So you can place a trade worth $2,000. The reason being is that you have the $1,000 in your account to pay for any potential loss. So you can open a trade worth $2,000. You have $1,000 of cash there. If the trade goes down 50%, you are wiped out. So with leverage, the moves are exaggerated, right? If you put $1,000 in and you have an actual $2,000 trade with the market, if it goes down 50%, you lose all of that $1,000. If it goes up 50%, you make $1,000 of the $2,000 nominal trade size, but that's like 100% of the collateral that you put in. So intermediate and advanced traders will use futures for shorter term positions and trading, just because they can open bigger size with less cash on the exchange. However, if you're a beginner or if you're investing, stick to the spot market. What I also suggest is that if you are looking to trade actively, this right here is active trading positions. I highly recommend that you invest in assets that are going up over time, indexes, S&P, NASDAQ, Bitcoin. And most of your cash and investment money goes into the 90% here. That can compound over time and make huge returns. Trading, active trading and active trading positions, whether it's day trading or you have positions open for 6, 8, 12 months, that is not a long-term investment strategy. That is trading, and it must make up a smaller amount of the total amount that you invest. Day trading or active trading should augment a larger investment portfolio. What we need to do is figure out which assets have decent compound annual growth and invest in those regularly, then take trading positions around the edges if we see very advantageous price movements. Basically, if the price of the asset is coming off and is relatively cheap, we can take long positions to essentially wait and then follow the trend upwards over time. And I'll show you all the data around this. But what I've done here is I've just asked Grok, or you can ask ChatGPT or whatever. Bitcoin has a compound annual growth rate, CAGR, of 20%. Now I said 20%, it's actually been about 40% over the last few years. I've just taken that way down to something like 20% just for this example. You can also invest in the NASDAQ, which has had about 18% compound annual growth over the last decade. The S&P 500 index, about 12% compound annual growth. So pick your compound annual growth. I invest $100 a week for 5 years. How much have I invested? $26,000. How much is the portfolio worth now? $67,000. The total return in percent, 158%. the money that you put in at the beginning is much more than that, but you're investing as the price is rising. So the money that you put in later obviously has a smaller percentage return, but overall it's 158% with a total return in dollars of $41,000. 26,000 invested, 41,000 made, $67,000 over 5 years if the asset is growing at 20% a year. This is what we need to be doing first and foremost. Then when prices are advantageous, we can wait and wait and wait for a good time to actually take a trade, and that trading part of our portfolio can augment to these returns. Now I'll show you how to get set up with your unified trading account. Now if you're trading on Bybit, it's called unified trading. Other exchanges are very similar as well. They'll have a trading account where you need to put the funds. Funding account is just where you put your cash when you're not trading it, or you can put crypto assets in there as well, and they are separate from your trading account. With unified trading, this is where you put assets to trade. Now, if you're just trading in the spot market, super easy. You put $1,000 in there or 1,000 USDT in there, and you can buy some crypto assets. They're in there, and that's it. However, if you're trading in futures, then the assets that you have in your unified trading account will count as the collateral that collateralizes your trades. So like I said, with futures, you just need some collateral in your account, and then you can open trades that are larger than the capital that you put in. So let's say you put $1,000 of USDT in there. That $1,000 is there. Most people do use stablecoins because the USDT amount is going to be 1-for-1 with the dollar. So if you know you put $1,000 in, you know you have $1,000 to pay for potential losses in your trades. That won't change because $1,000 is $1,000. What you can also do is put crypto assets in there as collateral as well. This is slightly more volatile and more risky because trading systems use the dollar value of assets as the collateral amount. Because if you're making losses in your trading positions, eventually you'll make losses where you won't be able to cover the losses anymore. That's when you get liquidated, which is where the exchange just sells your assets out to pay off your trading position and gets you out of the trading position. If you put crypto assets in here as collateral, you can put $1,000 of Bitcoin in the account. And if you take a Bitcoin long position, well, if the price falls, then your trading position loses money, but the dollar value of Bitcoin is going down as well. So your collateral is actually losing value as well. So hence it's way more volatile and more risky to do that. So you have to give yourself maybe a lot more breathing room with how much collateral that you place in to take trades. If you use crypto asset collateral, much more volatile. But you can do it, and the dollar value is used to collateralize your positions. Now on the other side of that is that if you're using Bitcoin as collateral, you put $1,000 of BTC in there, you take a long position, the price goes up. Now your trading position is making money and your collateral is actually making money as well because you're in the risk asset, which is rising. So it's the other side of that is pretty good as well, but it's way more volatile. So if you're beginning, maybe just use dollars or dollar-backed assets, and that is going to give you a fixed amount of collateral to trade with, and it's going to reduce the volatility of your trading positions. The assets that you use as collateral in your unified trading account are completely up to you. On Bybit, you can toggle these on and off right here. So what I'm going to do is toggle on USDe, and then I'm going to toggle off ETH, and I'm going to toggle on staked ETH. So what's the reasons behind that? ETH is a proof of stake blockchain. The ETH network pays staking rewards if you stake the ETH on the blockchain. The ETH token, the layer 1 token, doesn't pay any of those staking rewards natively though. So what I can do if I want to use ETH as collateral is actually use staked ETH. Staked ETH is staked Ethereum on the blockchain, and so it has a 1-for-1 value with ETH. However, it also earns the staking rewards. So because I have this token in my account, it's exactly the same dollar value as ETH, but I'm getting 2, 3, 4% in staking rewards on top, which is extra yield for me. So having the staked ETH there is just better because I'm getting that yield in, even though the 1-for-1 dollar value with ETH is the same, right? So I'm just earning 3 to 4%, whatever the staking rewards are, whilst using that collateral, which is a good thing because I'm actually getting payments in, which is adding to the collateral value that I have. It's actually very similar for USDe as well, which you can use on Bybit. Now USDe is completely different, so I'll explain that right now, but what we can do is toggle it on or off if you want to use it. USDe, as of making this video, is paying, I think, around 3 to 4% in yield as a stablecoin. So this is a US dollar stablecoin. It will have a 1-to-1 value with the dollar, or it should do, but paying 4% on top. And that's something that USDT and USDC don't do. It's up to the individual whether they want to use something like USDe when using collateral. And there are other platforms that have very similar types of tokens that kind of pay this yield. So what exactly is happening here? Well, with USDe, they are carrying out a very well-known hedge fund strategy known as a delta neutral strategy, which is where you give the dollars when you get the token, right? So you're giving dollars over. And what they do is they take the dollars and they take a long position and a short position with the dollars in Bitcoin and ETH. So they're 50% long and 50% short. So if the price moves up or down, half the side of the trade wins or loses, which is delta neutral because each side of the trade should cancel each other out, meaning they don't make any profits or losses. And so they still have the dollar there that they can pay you back if you want to get out of the token. The reason people use this, though, is because this trade usually makes fees out of the short side of the trade in the futures market in crypto, which means the yield on this token right now, I think, is around 3 to 4%. So if you're using dollars as collateral in your trading account, earning 3 to 4% on top is just more capital efficient. You're just earning more on your capital, which is obviously paying down some of your trading positions, right? So that's why people use these type of tokens instead of USDT and USDC, because these don't pay any yield. Now, of course, there may be some extra risks of holding this token, so you have to be sure of that. So I don't want to advertise the token or anything. I'm just saying that if you want to use a token, you're actually getting some yield in that in your account that can pay for your positions, 3-4%, which is why people use it. Now, when we're trading in the futures market as well, we may have to pay some funding fee, and that is going to be taken out of our trading positions. And so if you're earning yield on the stablecoin that you have in, basically that funding fee that we have to pay, most of that or some of that is being paid by the yield. It's up to the individual whether they want to use that or not. You can look more into it. I'll leave some links below on Athena and what it is and this type of stablecoin. But if you want to use it, you can toggle it on, and then you get paid that yield into your account from the strategy that they carry out. Now I'll come on to analyzing the asset that we want to trade. So come to your trading system, spot or futures. It's up to you, whichever you want to trade. Choose the asset that you want to trade. How are we going to get into a trade here? So the first thing we need to do is look at the long-term chart and the trend, and then we can drill down into shorter term charts and actually entering positions. So what I'm going to do is go over to Trading View. Trading View is free, so if you don't have an account, I'll link them below as well. Just go through, set up an account, and then you can trade on here for free. There is a paid version, but just use a free version. It's more than enough for most people. So on Trading View, top left, go and find Bitcoin. You can type BTC or you can just type Bitcoin or any asset that you're trading, right? It might not be Bitcoin. For me, I'll just show you Bitcoin here, US dollar. So I'm clicking that one on Coinbase. This is the chart, same as we got on Bybit, right? What we're going to do is first analyze the longer term growth of this asset and the trend of this asset. Can't really do that with a regular type of chart. So we'll come down to the bottom right. You can see the settings here. We're going to go logarithmic, and then we're going to reset the chart view. And that's going to give us this chart of the trend of the asset over time. And you can see the price scale crushes as it moves higher, and it gives us a kind of trend rate of growth of the asset over time. Now what I'm going to do now, we're going to have to try and figure out the trend here and if we can map the trend. So what I'm going to do is go to the left-hand corner, the brush here, toggle the drop down, go to curve, and I'm just going to try and fit a curve of the price over time on the bottom end. So we'll click this here, and that's the kind of bottom trend. So I'll copy and paste and fit the midline of this, and then I'll copy and paste again, and I want to fit the upper line. Right, so what we're going to do is just bring these down, because these are essentially trying to forecast that trend rate into the future, right? So I'm just going to bring these down, as I like to be kind of bearish in my analysis and, not try and figure it out going to billions per coin. So what do we have here is we have a three curved setup where we have the bottom end of the curve where the price tends to bounce from, right? So the trend rate of growth, right, for the long term, seems like the price bounces from that level. Now, it also seems like the price rejects from this level, which is the upper end of the curve. And this one in the middle, this will be the kind of trend rate, right? So if you were to take kind of the average of where the trend of the price is going over time, this is kind of the midline, right, or the trend rate. We're just going to put that in a different color, something like yellow, right? Right, so I haven't done this perfectly, but you can certainly see what I'm getting at. What do we want to do? When the price is low, right, or in the lower end, well, if you're an investor, you have to be active investing here, right? That's where returns are made. Returns are made where you buy it low and wait for the price to move up. Now, you can also just buy high prices as well. If you've got a long-term time horizon, you can see that the highs are getting higher over time anyway, right? So, it's not the end of the world. But certainly, if you're a long-term investor, what we're seeing here is an uptrend in the price. We are seeing very clearly now that there are areas where the price bounces from, right? And so you can make some trading positions and investment decisions around this. So we know that if the price ever gets to here, right, even though the price is much higher than it was before, that's actually quite low in relation to the trend rate of growth. right? So the price is low in relation to the trend rate. And if you think that the trend rate is going to continue, then that price is advantageous versus the trend rate. So you should definitely be buying here. That's for long-term positions if you're investing, or if you're investing, you can just dollar cost average over time. It doesn't matter if you've actually got a long-term time horizon, right? If you're short-term trading, we can also use this very clearly to figure out where we want to trade and where we want to be active and where we don't. So what I would suggest is that Bitcoin does bounce usually from this bottom line. And when it does, it tends to trade up in a volatile fashion, but it tends to move upwards in an uptrend, right? So that's what you want to figure out. So we've bounced from here. Yes, we've got some volatility, but we're moving up in an uptrend over time, right? And so those trends tend to continue for a while and actually don't tend to top out until Bitcoin is very overvalued here. So let me just say this very simply. If the asset that you're buying is trending upwards, you want to generally be buying it and going long that asset, right? Going short the asset is against the trend, which is like swimming against the tide. So I don't want to be shorting the asset. I want to be longing the asset, right? And I want to be trading long during uptrends, which is where the price moves from low upwards to the midline or from the midline up to the top line. So I want to be going long in uptrends. And because I've done this long-term analysis, it's pretty easy to work out these trends and where you are. So as long as the price is low or mid, or even just above the midline, I'll be trading it, and I think that I'll be making a decent risk-reward trade where you're in an uptrend and you're moving up. The places where I don't want to be trading long is where Bitcoin, no matter what the price is, Bitcoin is high in relation to the midline trend. Its trend rate of growth is this midline. If Bitcoin price is up here, or any other price, then that's not really a great trade to be in. Because can the price move upwards like this, completely and totally outside of its trend? It's very unlikely. So up here, I don't want to be trading long. I don't want to be taking too much risk, because risk is expensive at this top line. When risk is cheap, that's when I want to be buying risk, right? You want to be buying risk. You want to be buying volatility down here because it's relatively cheap in relation to the trend. Up here, it isn't. And so I don't want to be taking positions. It's as simple as that. So where the price is in relation to the long-term trend, I think we're still good, and we can take risk and we can try and buy to see if this uptrend continues over time. I also want to show you this analysis with a completely different type of asset class to show you that you can use this across different types of assets. This is the NASDAQ 100 index, mostly made up of technology stocks, consumer staples. This is an index of the top 100 non-financial companies. And so again, we have a trend rate of growth over time. It's very clear to see. This is on the logarithmic chart. And what you want to do is figure out an upper, mid, and lower bound, right? And so the midline you can see is pretty clear. That's the trend rate of growth. And when the price does get down to this bottom end, it seems to get bought up and carry on its trend. And so these prices are certainly the most advantageous prices where you're going to get the best returns. Now, it's not easy to buy these because the price is low. Everyone's scared. It's usually a bear market. Everyone's panicking, but that is where you are going to make money when you are buying the quality assets in an uptrend when the price is relatively low in relation to that trend. You can see up at the top here, there's a huge overvaluation. You actually came from the top down to the bottom. Everyone buying in during all of this, of course, is sitting on losses. Everyone's panicking, the end of the world. But you can very clearly chart this. You can very clearly see that over time, right? So it works on assets that have this fundamental growth over time and that are moving in uptrends. And then exactly, do you want to be taking massive leverage trades like this when the thing is overvalued in relation to this midline trend? Probably not. And it's as simple as that. You have to be super patient and wait for these opportunities, but you get them time and time and time again as the price moves lower into this area. I mean, if you're trading these, right? If you're trading these and you're taking long positions with a 6-month view or something like that, these are good trading positions to be making. Now we can come to our trading chart and try and find some advantageous prices to trade. If you're trading long-term and you're just dollar cost averaging in, just buy every price with the asset moving up over time like I showed you at the start of this video. If you're trading, especially with leverage, there's only one thing to focus on. It's not how much you can make. It's not how much the price moves up. It is the potential loss in your trade. 3 parts to every trade: the entry, the exit. But if you are trading, especially with borrowed money, with leverage, right? So you have $1,000 in your account, you've got a $2,000 position. That means you can handle a 50% drawdown, right? Until your $1,000 is wiped out and the trade is unwound for you by the exchange. If you're trading with leverage or in futures with any margin, the potential loss is the only thing to worry about. You've done your analysis. You know you're in an uptrend. You need to get the entry price where you know that the average potential loss is going to be fine for you to the downside, right? So if you're using 2x leverage, you can handle a 50% drawdown. You need to make sure that the price that you're getting in, you think on balance may move down 10, 20, 30%. You can handle that. If you're getting in during this kind of massive uptrend move, right, and you're buying peaks, those peaks tend to draw down into the trend. And that means you are sitting on a drawdown at that point. Now, it's not to say that you have to buy pullbacks, but if you're buying breakouts like this, it's very difficult to figure out where the breakout will get to before another kind of drawdown into the trend, right? So the easiest method is to be patient and wait for drawdowns where if the price is already drawn down 20 or 30%, then the probability of it going down another 20, 30, 40% is actually relatively low if you're in an uptrend. So that's what I'd say if you're beginning, is actually to be extremely patient and wait for these drawdowns, right? Because these are more advantageous prices. They just give you a better risk reward for your trading positions. If it's already drawn down 20 or 30% from those highs, is it going to draw down another 20, 30, 40%? Now, sometimes it does when it goes into a bear market. We're going to lose that trade. No problem. As long as we're trading over time and making good risk reward trades, we should be making profits in our trading account. So on your trading system here, what I want to do is put indicators on. Moving average. This one here, I've put 2 moving averages on. Super simple. This one is a 50 period, I believe, in white. And this one is a 100 period. Because I'm on the weekly chart, this is a 50-week moving average. This is a 100-week moving average. So what can we see here? Big uptrend, right? The price is down here, right, mucking around, and then the price moves up through both of these. So the price is moving up. 50 periods means 50 periods of 50 weeks, because it's a week chart, 50 weeks of price data smoothed out. This is 100 weeks of price data. So as you can see, the 50 week is moving up through the 100 week. Short term price is moving up, bull market. 100 week then eventually moves up. So now we've got price above the 50, 50 above the 100, 100 moving up, uptrend, big time, right? But you can very clearly see that there are times where the price moves down into the trend, right? Now it's bouncing from that trend, which is obviously confirmation again that we're in an uptrend. But we don't want to be caught out up here, taking leverage, getting drawn down on. It's difficult. So we have to be patient and wait for fairly weaker price action, drawdowns from the highs, and then we can try and get in, maybe make our trades. You don't have to make one trade. You can make 1, 2, 3, 4, add to your position to get the amount of money that you want in. But this is the simplest way, is to try and actually wait for the price to bounce into these trends. Because otherwise, if you're trading up here, yes, you could get a breakout short term, but it's far more risky and it's far more for advanced traders there. Another resource that you should be using with crypto is on-chain data. I'll leave some links to Glassnode and a few other sites where you can really dig in deep to some on-chain data and actually feel how the market is moving. I just want to focus on this one, which is drawdowns during bull markets for Bitcoin. When you're trading, right? I know there's loads of trading techniques out there, chart patterns and everything else. This is the real data that we need to use. This lets us play the percentages. When you're trading, it's about playing the percentages and getting a good score, right? If you play golf, you know that you don't go for the hole every single shot, right? You actually just want to go for the middle of the green and 2-putt and get your par and get out of there. If you go for the hole, you're going to put it in the bunker and you're going to make a bogey, right? You have to play the percentages to shoot a good score. This is the percentages, right? This is showing the current bull market that we're in Bitcoin. And these drawdowns you can see on the right-hand side, 10, 15, 20, 25%. So 25% drawdowns have been quite rare. 20 and 15% drawdowns, they've happened all the time. Just imagine if every drawdown, 15 to 20%, you just go enter a position, enter a position, enter a position, enter a position. All these positions that you can enter in, right, where you're getting a very good price in an uptrend and you are playing the percentages that if the price draws down 20%, drawing down 25, 30% is actually unlikely. And so your risk of loss, right, the percentage that you're playing in that trade is super good for you. So play the percentages. Don't worry about chart patterns and all these little things on a daily basis. Zoom out a little bit. If over the last 12 months or so, you've just been consistent getting in these drawdowns, you've got great entries for your trades and the price is moving up. Now, at some point, you're going to want to sell out of your trading position. It's not one in, one out. Think about adding to the position, adding to the position, adding to the position. During this drawdown, it's a long time, right? During this drawdown, it's a long time. You can add to the position, get better prices, dollar cost average into the position over time. Not one in, one out. Day trading, one in, one out. Okay, but this one, we're playing the percentages. We can get in over and over. We can get decent prices. We can increase the size of the trade, which means that we can, make bigger amounts of those moves. If you're day trading in and out all the time, very, very risky. This, we're playing the percentages. We're hitting it to the middle of the green. We're making a good score over time. Now, at some point, you're going to get a big bear market drawdown, but you can go to your longer term charts again and figure out when that may be, right? We know that the longer term drawdowns tend to happen when the price is high in relation to its trend, not at the mid level or at the lower level. So you can use all of this data together to actually figure out when you want to enter decent risk reward positions. Now I'll show you exactly how to open a trade on Bybit. I've got much more in-depth guides on using crypto trading platforms. So if you want to know how to get money in and out, how to set yourself up on the platform, all of that is linked below. But in the right-hand corner, I'm trading in the futures market here. So cross margin, this is where all of the collateral that you have in your unified trading account margins all of your positions. So you can have a Bitcoin and an ETH position, and you're using collateral to fund all of those positions. Now that means that if one of the asset or one of the trades loses, it also can affect your collateral, collateralizing the other trade. You can also use isolated margin, which is each individual position has an amount of collateral that you use for that position. It can win or lose, and that's it. If you lose that trade, the other positions that you have that are collateralized with other assets won't be affected. It's up to you what you want to use. Isolated, maybe if you're a beginner. If you're a bit more advanced, you might want to use cross. I'm using 2x leverage. Leverage is the amount that your trade size is in relation to the cash that you put down. So 2x leverage means that if I put $500 cash down, my trade size is $1,000, 2x. If I put $1,000 down, my trade size can be 2x, which is $2,000. So think of it as the amount of your trade size versus how much cash you have put down. Right, so I'm going to open a market order, and let's say the value of my trade is 150. You can see that the cost to me is 75 because I'm using 2x leverage. So if I want a trade size of $150 with the market, because I'm using 2x leverage, the trade size is 2x my cash, 75. 75 times 2 is 100, 150. So if you put 200, the cost to me is 100, right? So 2x leverage, $200 trade size, $100 cost. So that's how that works. What this means is I have $75 down to fund losses on this $150 trade, which means I can survive a 50% drawdown. If I were to use 3x leverage, my trade value is exactly the same, but my cost is now different. Because I'm using 3x leverage, my trade size is 3x the cash that I put down. So I only now put down $50. But what's changed is my liquidation point. Now, 150, I've only got 50 to pay for losses. So I can only now withstand a more or less 30% drawdown. If you use 10x leverage, what does that mean? Well, it means that the cash you put down is times 10 for the actual trade size. Now I can only withstand a 10% drawdown before my $15 gets liquidated. 10x leverage is crazy. You're going to get wiped out, right? So for something as volatile as Bitcoin, right, 1, 2, 3x leverage is probably what you want. I'll just choose 3 here as it seems I can't choose 2. I can customize this. I can go to 2x leverage. So that's what we'll choose. And press confirm. So I'm putting down 50%. So I can withstand a 50% drawdown. Now, what you can do with short-term trading positions as well, this is probably not a great price to get into. As you can see, it's an all-time high, but we can put a stop loss in, right? If you want to do that. Now, I would suggest that with trading positions, this is a very small part of your portfolio anyway, and this is cash that you are trading with higher risk. And so I would suggest that each year, if you have a trading amount that you are risking, then do you really care if you get stopped out of the trade? Maybe, maybe not. It's up to you, right? If you have your investing bag anyway that you're adding to over time, and you have a active trading portfolio, maybe, and what I used to do when I was trading and working, we had our trading portfolios as well, that you would just have an amount that you traded with each year, and you took these positions, and if you lost for that year, that your trading positions. But it's up to you if you do want a stop loss in there. You have to figure out though that if the volatility of the asset is, let's say, 30%, you don't want your stop loss too high, right? So if you get in here and your stop loss is 13% away, well, 13% is totally normal. We've seen the typical drawdowns of 20 or 30%. So if you're trading a drawdown here and you've got a 10% stop loss, which means you get out of the trade and a 10% loss, you're just going to be taking small losses all the time, because 10% is totally normal volatility. If you want a stop loss at around 45%, what's the point? Because you're getting stopped out at 50% anyway. Do you really care, right? So I think maybe just have your trading positions as let the trades run, but it's up to the individual if you want a stop loss, which gets you out at a potential loss. So if you click this one, it says stop loss here. You can put the stop loss at some price. So we're getting in at 100. If you want the stop loss at 75,000, you can see it say, it's a 50% or 58% loss because we're using leverage here, right? And so, that's the loss on the amount of cash that we put down. So you can put that stop loss in if you want, and that actually gets you out of your trade at that specific loss. But again, if it's close to your liquidation point, what's the point anyway? So what I'm going to do is not do that. And I'm just going to enter the position to show you how these positions actually come on. So open long here, just confirm all of this like that. And we should see now that we have our open position. So we have a position here. We're long the asset. You can see that we're 2x leverage, the value of the trade. This is the entry point and everything like this. And then you can see the running P&L of the position. So you have unrealized P&L. That means that this is the profit or loss that you're making in the position as is. You can also get out of the position and realize the position if you want. So let's say you want to get out half the position, you can do that. And so that would be a realized P&L because you've realized a profit or a loss from the trading position as well in some part of the amount that you've taken out of the trade. If you want to take profits in the trade or maybe take losses and actually reduce the position, go down to the right-hand corner. You can see here, just above my head, you can see limit and market, and it says close by. So we've got an open position here. We want to close some of the position. So I'm going to close by limit order. And what you can do is close 100% of the position or 50% of the position or anything else. So if you're making profits, you can just get out as the price rises. If you do want to close down the position and take losses, you can do that as well. So let's say we want to get out 50% of the position. Let's use a market order just to make it easy. Market order, 50% of the position, I can get out, press confirm, and it gets you out of the position, reduces 50% of the trade size. Or if you want to get out of the whole thing, just use a market or limit order. I want to get out 100% of the order, and then press confirm. That will get you out of the trade, so you now have no trades running. So another tip here is that if you are looking to trade, now I don't think of trades as one in and one out, right? That's not playing the percentages. One in, one out is like trying to go for the the pin, right? Trying to hit a 4-iron into the pin. Yeah, you're not going to get there, right? One in, one out is like going for the absolute worldy shot that you're not going to make, right? So what I like to trade, what I like to do when I'm trading is get into positions slowly. You don't have to go in one out. You can go in a little bit, start to get in. If the price moves way up, well, you've made money, but the risk is if it moves down, then you can actually have some cash there to start getting into the trade. You can dollar cost average entries and dollar cost average exits. I think that's playing the percentages, right? Rather than I'm just going to get all in here and then I'm going to be really nervous and the price goes down a bit. If you have some cash left over, you can get in. Just play the percentages. Yes, of course, if it moves right up in your face, you would have wanted to put all of it in, but that's playing percentages, right? Look, it's a long road, right? And it's a long bull market. It's a long uptrend. So there's opportunities everywhere. Get in slowly, get out slowly. Treat trading as a small percentage of your overall portfolio. If you want to trade on Bybit, click the link below in the description. You can get up to a $30,000 deposit bonus. Loads of other helpful resources and videos all down in the description. I'm James, it's ManZG. Cheers for watching, and I'll see you in the next one.